Welcome back to my channel. Balance sheets matter. Today we're going to be looking at Alibaba. This was a subscriber request, so we're going to do a stock analysis on Alibaba. But before we get into the stock analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do an individual stock analysis video, so if you want to get ideas on potential good stocks to buy or value traps to avoid, make sure to subscribe to my channel. And I will say Alibaba was a stock I did before, actually over a year ago. It was the first stock I did analysis on. And there's a reason why I called it the Chinese Enron, accounting fraud hidden in plain sight. If you want a more detailed explanation of the count and exactly what I'm going to go over, you can watch this video. The video is not very good, the audio is not very good, but I will go into a lot of detail of the exact accounting practices, which I'm going to try to briefly describe here. So a lot of people get interested in Alibaba because it's low PE of basically 17.86 and is very low forward PE of 8.59. But I'm going to explain now why that really isn't the case. And I'm going to try not to overcomplicate this too much. So we're just going to look at a few highlighted parts basically of the financials. So the first thing I'll just go over, which I usually technically always do, is look at the gross margins. And you can basically see since they've kind of basically gone public at the end of 2014 into 2015, gross margin has been declining significantly. And typically when there's a slip in gross margin, it means you're losing your basically competitive edge. And the same thing with the operating margin. But where all the trickery starts is what people see as interest income and interest expense, which doesn't actually have to do anything with income or with an interest expense. This gets into how Alibaba is structured. Alibaba is a holding company. It's not actually the individual company operating itself. And what they own is they own thousands, if not tens of thousands, of all these little sub companies. And this gets into basically how the accounting works. If they own more than 51% of any of these little entities they own, these thousands of other little companies, then there's the accounting gets consolidated in their financials. And this is what we see in the income statement, the balance sheet, and the cash flow. But if they own less than 50%, say 20% to 50%, you start using what is called the equity method of accounting, when they have significant influence and own approximately 20 to 50% of the stock. Then all the different income statement, balance sheet, and cash flow is not reported here. What they do is they just basically adjust what the fair value of the company is, which is quite interpretive, as you know, of how stocks basically work. So for example, if the stock was, or value of the company was $100, it goes up to 105, they would show a gain on the interest income here. And if it went from $100 down to $90, they would show basically an interest expense here. And that's basically exactly what you see. That's why from, for example, 2015 to 2021, you see all these big gains, $10 billion in 2020, $11 billion in 2021, when the market was going crazy up because all the Chinese stocks were going up. So they can do these fair value adjustments and say, oh, all these different little entities we own, 40% or 49% are worth a lot more. But then as the Chinese stock market basically crashed like the rest of the market in 2022 and 2023, they have to start marking these down and showing these losses. And the problem is which I explained more in the other video, is Alibaba is very selective of which companies they put on basically consolidating their accounting. For example, a portion of Alibaba Pictures, for which you would think would be in this consolidated accounting, is not. Some years ago, they actually diluted themselves down to 49% ownership. But even in that process of diluting themselves to 49% ownership, because there was a new investor in, which, it could just be them from the owners from a different entity, it actually raised the value and they get to show a gain. So Alibaba Pictures was losing money, and instead of showing it in the consolidated accounting and showing the expenses and basically that were causing a loss, they just get to show an interest income gain for it. And that's basically where this whole trick gets in, is you really actually can't determine what the hell's happening with Alibaba at all, because of all its little thousands or tens of thousands of entities it owns. It's just showing you the ones that they want you to see. You can't actually see what's happening under the books. And that's where a lot of this deceivingness of the PE and the net income comes in, because you look at net income, basically 2020, 2021, 21 billion and 23 billion, but 10 billion and 11 billion of that was just fair market adjustments to entities they own, which probably actually don't have any liquidity at all. Really, in reality, what they wanted to show, what they actually are able to show from the companies that they do show on the accounting, was 13 billion. So just from the forward PE of seeing 8, I can't really determine if it's actually going to be 8, because how much of that is coming from these basically, fair market adjustments up, because you see they've started doing some in the recent basically quarters. 2020 in December quarter ending 2022, they had $2.2 billion. They said, oh, our stocks, our entities we own went up that much, so we report that much basically of income. And then in the quarter ending March 2023, 1.5 billion. So really what you're seeing from Alibaba's PE is completely meaningless. And this also kind of then ties into this declining operating margin and declining gross margin. They've been trying to make it look like they're growing really fast, but they have worse and worse parts to basically put in Alibaba to fuel that revenue growth. Because if they basically have a company they own 49% and then they flip it to 51, they can show it now in their revenue, and it can show these big revenue boosts, but the gross margin's going down and down and down. So all this recent additions they basically had in the last 4 years or so, 5 years, have actually been dragging their overall gross margins down, meaning that there's really not very many profitable parts of Alibaba left to basically put on any growth, and anything that probably is sitting on kind of in this equity method of accounting is actually probably losing a ton of money. But it gets a little bit worse. Like, can kind of skip past the balance sheet here, not so important. Let's get into the cash flow statement. So first thing you see, stock-based compensation. Quite a lot of stock-based compensation. So this is the thing, is the management is paying themselves out quite a bit. This is like tens of billions of dollars here. What, you got 10 billion, 20 billion. This is 30, maybe even getting the $40 billion management's compensated themselves effectively in stock-based compensation. And while they are buying back shares, it's really just, and here's the repurchase of stock here, it's really just offsetting what the stock-based compensation is. Like if we go back up into the income statement, you'll see shares outstanding since when they went public, end of 2014, so starting 2015 here, 2.5 billion shares, and now they've gone up to 2.576 billion shares. So even though they've dumped a lot of money into share repurchases, it's just kept their share count the same because they have so much stock-based compensation. A lot of people see Alibaba, another thing I frequently hear, and people who get trapped in it, they look at the free cash flow. Look at all this free cash flow. They're making a ton of money. Well, first of all, you have to remember what is free cash flow. First of all, the free cash flow is basically the cash flow from operations minus their capex, their purchase of plant, property, and equipment. And this is also being propped up by the stock-based compensation, but the majority of Alibaba's investment is not actually in the main parts that are consolidated in their accounting. Remember this equity method of investing. So any entity they own more than 51% of is going to basically end up in this line here, the purchase of plant, property, and equipment. But you can see the majority of the money actually goes to purchases of businesses and purchase of investments. And these are all these sub-entities they basically kind of get to keep off the books, but still get to show the gains from when they say the value goes up for it, which accounts for actually, the majority of their investment here. You can see, for example, like here, 2019, it's purchase of plant, property, equipment, 5.2 billion, but purchase of business, 7 billion, purchase of investment, almost $11 billion. So you look at all basically the cash flow from investing, and it's effectively completely offsetting any of this cash flow from operations. And that's not even accounting for this outflow of, the stock-based compensation. And that's because kind of this, why I call Alibaba pretty much a scam, and the Chinese Enron, and it's accounting fraud hidden in plain sight. They'll pass all the audits since they can legally just use this equity method of accounting and just show you only the portions of the company they want to show you. And any money they're actually making is basically just going out to management through the stock-based compensation, and then through all the other purchase of businesses and purchase of investments, they basically funnel money in to kind of just keep these other entities afloat. But as I said before, the very fact that we can see from their gross margin heavily declining, they are running out of basically viable businesses they can show this growth with. So, it's really hard to say if Alibaba is even profitable at all, because at the end of the day, they actually really haven't made any money when you really break it all down, which I did in my other video. So, I basically, the thing is it's probably going to keep, going going all right if, the market keeps believing it. A lot of times these accounting fraud things like Enron, it can take a lot of time to catch up. Is it going to catch up to Alibaba right now? Well, I don't know. But if they start basically posting, these big fair market gains because the Chinese stock market starts going up and showing this income, I would bet the stock's going to go up again. Although it's not a really viable investment. You're kind of playing with this ticking time bomb that when it kind of catches up to them, you're probably going to see these gross margins keep on declining down, or the revenue basically plateau. And at a certain point, all the revenues that they actually are making from these profitable businesses and they're funneling into the unprofitable ones is probably going to catch up to them eventually. And by then, management's going to have cashed out even more money, tens of billions of more, and you're probably going to be left high and dry. But that's kind of what I see in the accounting. Again, watch my other video. I think I go in for a lot more detail. I'm just trying to explain the broad concept in this video. But I hope you like that analysis. I hope it made a little bit of sense to you. It's a very complex topic to explain, but if you did like the video, make sure to subscribe to my channel, like the video, and I'll see you hopefully in the next stock analysis, which will hopefully be a little bit more positive and a little bit more clear and straightforward than Alibaba.